Bitcoin's an asymmetric opportunity, and then these Bitcoin treasury companies are an asymmetric opportunity on top of Bitcoin. And the thought that process that a lot of Bitcoiners have is like, hey, where's the yield coming from? This reminds me of FTX, and this is a GBTC-like instrument. And each one of those thoughts is kind of incorrect and relatively lazy thinking. And my hope is to get people to spend the time to see if those are accurate or inaccurate and to evaluate this based on probability analysis. Like, what's the likelihood of this working? And then what's the upside return of these Bitcoin treasury companies? And those are enormous. So the risk is low and the upside is high, which we can get into, I'm sure, on this call.
Hi everyone, welcome back to Stephan podcast, brought to you by Bold. American listeners, you can buy Bitcoin and sell Bitcoin over at getbold.io. Now, joining me on the show is Blake Canfield. Now, Blake and I, we actually first met in 2019, around the Bitcoin 2019 conference in San Francisco. So, welcome to the show, Blake.
Happy to be here, Stephan. It's been a while. It's great to see you every once in a while, and it's great to see, I know we were chatting at lunch one time and you were thinking about starting a podcast, so it's good to see that it's successful.
Right, yeah. So, look, it's been a while. I've seen you around at different conferences, and now, obviously being down the Bitcoin rabbit hole, but in, let's say, recent years, this Bitcoin treasury company it's almost like its own little rabbit hole as well. And so right. Let's hear from you. What was your interest in this Bitcoin treasury company rabbit hole?
Yeah, I think the interest for me is how the debt market is going to come into Bitcoin, or so the fiat market. And so the debt market to me, the US treasuries and things of that nature are the most obvious to come into Bitcoin first. And that's always been my total addressable market of Bitcoin and measuring that value, if that makes sense. And so what's unique about the Bitcoin treasury companies, they're kind of the tools or the spigots to plug into the dam to start to get that money to come into Bitcoin. And they're like a flywheel that's using that kind of energy and that pressure to drive Bitcoin yield and accumulate more Bitcoin per share. So that's what interests me, that general framework of, okay, they're tapping the debt markets to bring that market, all that debt and that currency into Bitcoin. And that just made a ton of sense to me.
Yeah. And so, of course, addressing just kind of upfront elephants in the room.
Yeah.
There are some obvious concerns that some people will have, so I can understand for some people on the, let's say, the cypherpunk side of things, where maybe they see this as kind of, it's against the ethos. And then maybe the other big category would be those from maybe more of a religious or ethical, let's say, aversion to this idea. So, for example, if the idea is people might be against debt or usury, and for this reason, they're against this idea. So, I'm not personally against this idea of Bitcoin treasury companies, but I can understand where maybe there are other people in the Bitcoin world who might have some objections to these things. Any thoughts from your perspective on those? Yeah,
definitely. So the way I look at it is you've got these very important Bitcoiners that are the hodlers of last resort. They hang on to their Bitcoin in cold storage. What these Bitcoin treasury companies are the teams or organizations that are going forward into the capital markets and taking market share from the fiat currencies and throwing it into Bitcoin at a high rate. And so it's great to sit back and kind of have that huddle of last resort mindset, which I'm a huge fan of. But to me, there's nothing better than being proactive and going into the market, going to the debt system and bringing that money and that capital into Bitcoin at a high rate. And that's what these companies represent to me. So it's an active process versus kind of waiting for the debt market and a Bitcoin adoption to come to you. So you see a lot of these Bitcoin treasury companies influencing governance for governments, and then bringing in and pitching, hedge funds, insurance funds, and things that, as well as building products to help that flow come into Bitcoin. So there is that, kind of thought process, but that's how I look at it. And I'd much rather be on that kind of proactive, going out and bringing that capital into Bitcoin type mindset rather than just sitting back. And the beautiful thing about this system is that you can still have, some percent in your cold storage, and then you can also put some in these Bitcoin treasury companies that are taking a more proactive approach to bringing the fiat currencies into Bitcoin.
Yeah, and yeah, to be clear, I'm in favor of this idea also. I think it is a way to help onboard new people, but I can also understand there may be people who have concerns from, cycles gone past, or they think this is like, oh, it's that same kind of thing again, or people are doing this kind of, in cycles gone past, there was this kind of, I like Bitcoin, buy my shitcoin kind of thing. And now this is the new quote unquote shitcoin. It's not, I don't think it's a shitcoin, but I can understand where there's like a loose parallel for some people. So yeah, anyway, yeah.
There's a lot of parallels, and I think the way that I look at it is I feel like I'm it reminds me of being early in, Bitcoin when we were in 2019 at the conference, where we're trying to convince our no coiner friends to buy Bitcoin. We're trying to articulate the value of it. And they're saying, hey, it's too risky. And we're going, actually, Bitcoin's not risky, and here's why. Here's the total addressable market. How could it be risky? What are the scenarios that would make it risky? And how do you compare that to traditional banking systems, fiat currencies, equity markets, and things like that? Well, the same kind of thought process and logic apply for me right now, trying to convince Bitcoiners that this is not a risky investment compared to other traditional investments of investing in NVIDIA and some of those stocks, right? And so you have a very simple model of taking the debt from the fiat currencies and putting it into Bitcoin and leveraging that very simple business model. Hey, this fiat currency is depreciating by 10% a year, and we're putting it into an asset that's appreciating by 60% a year. That's the model. And then the mechanics of it we can get into, but there's all these different tools and things that kind of impact that. And that's what it's like for me, that I'm trying to communicate to my Bitcoin friends that, hey, this is not something you should sleep on. The way I think about it is Bitcoin's an asymmetric opportunity, and then these Bitcoin treasury companies are an asymmetric opportunity on top of Bitcoin. And the thought that process that a lot of Bitcoiners have is like, hey, where's the yield coming from? This reminds me of FTX, and this is a GBTC like instrument. And each one of those thoughts is kind of incorrect and relatively lazy thinking. And my hope is to get people to spend the time to see if those are accurate or inaccurate, and to evaluate this based on probability analysis. Like, what's the likelihood of this working? And then what's the upside return of these Bitcoin treasury companies? And those are enormous. So the risk is low and the upside is high, which we can get into, I'm sure, on this call.
Sure. Okay, yeah, great. And so let's talk a little bit about setting the table a little bit of like, what are the terms we're talking about here? Because there's treasury companies who merely buy Bitcoin and hold it on the balance sheet. But then there are also the Bitcoin treasury companies who actually take leverage, issue equity at the market, or use some other equity and debt structures to, let's say, proactively get leverage and get Bitcoin that way. So here we're talking about this, those companies. So I guess the way I'm understanding it, I'm curious to get your thought on this as well, but the way I'm seeing it is, every company should be doing at least holding Bitcoin on the balance sheet. But the question of whether, every company should be using fiat leverage, maybe that's a different question. How do you see that?
Yeah, there's two different things. There's one is putting your cash flows on the balance sheet. And then the second is really taking the debt market and using a judo move and throwing it into the Bitcoin space and generating yield on that. And so I think something that would resonate for most viewers is the analogy around a real estate developer developing real estate. So right now, these Bitcoin treasury companies you can think about as a real estate development company, and right now they have, let's say, 10 houses in their portfolio, and those houses are growing at 60% a year, which is traditionally what Bitcoin does. But in addition to that, they're doubling. One company, Metaplanet, is doubling their housing stack every 60 days. So not only additionally are their houses going up by 60% a year in value, but they're increasing the rate of acquiring pieces of real estate, homes, by double every 60 days, so every 2 months. In addition to that, they're using the leverage of the fiat system to do it, but they're keeping that leverage minimal. In other words, they're only Michael Saylor is, I think, about 20%, and then this company Metaplanet is only 10% of their net asset value is in debt. So, that to me doesn't sound risky, because most homeowners in the United States take over 80% debt to buy their home, and that sounds much more risky than these companies. So I think it's not inaccurate to say it's a leverage play, but to simplify it like that and saying they're not taking this debt, putting it into Bitcoin, acquiring more Bitcoin, their assets go up. It's this flywheel positive feedback system that is the real kind of understanding of the mechanics that you need to understand, not just simply we're taking on debt and that's it. So there's a lot of mechanics behind it, but that's the way I think that home analogy kind of resonates. And once you start to see it from the debt perspective, how much that asset's appreciating 60% a year, and then how many more assets they're acquiring, homes, is doubling for some of these companies every 60 days. And so when you put it in that perspective, you start to say, okay, that doesn't sound as risky. That's a mental framework that we can comprehend easily and effectively. And then we can kind of get into the nuance and details there.
Sure. And I guess the other big question people will have is, what are the pieces that are required to make this work, right? Like, I guess it's not just one piece, right? It's not just take out debt and buy Bitcoin. They might also have some form of equity financing, and they may have, in this case, a public company structure. So maybe if you could explain from your perspective, what are the pieces required to execute this strategy? And then we can sort of get more into some of the differences and the nuances.
Yeah, of course. Yeah. So taking a step back, just not in the mechanics, I like to think about the capital pools that they're leveraging or using. And why that's important to understand is that in Japan, they have extremely low interest rates, and their equities or their stocks have done really poorly over the last 40, 50 years. Why that's important is that they're desperate to get out of their equities, their stocks, and their bonds. So they're looking for yield. And what companies like Metaplanet are doing are allowing them to get out. How they're doing that is they're using different tools to capture that demand. So they have fixed income products that some of these companies are selling. So MicroStrategy is selling a fixed income product. They also have the ability to buy or issue more shares of their company stock when the company is overvalued compared to the assets they have underlying, which we'll get into a little bit later. And then they also have ability to do convertible debt and some other financial instruments. But the big aspect is just, and then the equity market is important because these equity investors, let's say in Japan as an example, are putting money in to Metaplanet, and that's allowing them to buy more Bitcoin. So not only are they taking out debt, the equity investors are also speculating and investing in the company, which gives them more resources to buy more Bitcoin at a high level. Does that make sense?
And so, I mean, I think it's like a whole new world to sort of understand, and it's not the typical thing that people are used to, right? Because, obviously, if you're coming from the Bitcoin perspective, it's about, buying and hodling. If you're coming from the traditional stock investing world, you're thinking, okay, like what's the PE ratio of this company, and is it profitable, and this kind of thing. And then here we're it's like people taking public companies, getting debt, and sort of accessing this cheap capital, let's say, relatively cheap capital compared to the appreciation rate of Bitcoin. Now, the obvious big question a lot of people have is kind of mNAV. Why is mNAV, greater than 1? Is it sustainable greater than 1? Can you give your high-level answer on this, on, what is mNAV and how or why is it sustainable greater than 1?
Yeah. So the mNAV is the multiple to net asset value. So really that's a complicated way to say their Bitcoin on their books at the moment for these treasury companies. So if they have 100 Bitcoin and the company is valued at 200 Bitcoin, that a net multiple to net asset value is 2. Why this is important and why it's almost irrelevant is because people are taking the old framework of the GBTC, which was a closed-end trust, so people aren't familiar with it. And so what that was for the last, I think, 10 years was a trust that would store your Bitcoin before the ETFs. And it was a one-way trust that only would buy Bitcoin and would never sell it. So sometimes it was a very rigid system, and it traded a slight discount and a slight premium. So a lot of Bitcoiners come in with the mindset they're waiting for that premium to increase or decrease by slightly, and they'll wait to get into the trade. Why that's not the healthiest way to think about it is because the Bitcoin yield is vastly more important, going back to the real estate analogy. So using the real estate as the analogy, the developer's company is valued at 2x what the real estate is worth right now in this analogy. And so they can issue shares to buy more houses. Let me take a step back actually before going back.
Or maybe the analogy is more like they can make more new houses, right? Like if they could.
Well, let's get into the difference between the mNAV mindset, which is like waiting for the mNAV to kind of be up or down a little bit. Because I had a very famous Bitcoiner talk to me at the conference, and he mentioned that he's waiting for the mNAV of MicroStrategy to reach 0.5, which is half the value of the Bitcoin that they have on site, which is on their books. And why that's not a healthy way to think about it, it's an old way thinking about it from a GBTC trust mindset. Markets are forward looking. So if the company is generating a 400% yield or doubling their Bitcoin every 60 days, that means that we can do an analysis and say, okay, let's imagine that a Bitcoin company has 10 Bitcoin. And every year for the next 10 years, or let's say 5 years, they're acquiring 10 more Bitcoin each year. We need to ask ourselves, what is the present value of that Bitcoin company that has 10 Bitcoin right now, but they're going to acquire 10 Bitcoin every year for the next 5 years? And so what that means is that there's going to be a premium on top of the value of that company over what they currently have. And so that's what a lot of Bitcoiners are missing, is this Bitcoin yield or ability to acquire Bitcoin at an annual rate is what allows the premium to exist, because the market knows that these companies are acquiring Bitcoin. Therefore, the company is going to be measured at a higher value than its assets. So if the assets are 100 Bitcoin, the mNAV is 1, and the values company is valued at 100 Bitcoin. But if they have that ability to continue to acquire Bitcoin over the next 5 years at a 400, 600% rate, that means we have to value the company at a premium today. Does that make sense?
Yeah, I'm with you. So let me take another shot at explaining it in another way. The point with when we talk about BTC yield, what we're talking about here is it accretive, right? It means per share, is that company acquiring more Bitcoin, even accounting for dilution? So even accounting for if they had to issue shares, or if there was notes that had to convert into shares, assuming full, dilution, do those shares effectively count for more Bitcoin than they had previously? And that's obviously the point of these treasury companies, that if they're not getting a BTC yield, then there's no point, correct?
Correct. That's accurate. Yep. And so as a shareholder, you have one share and you expect your share of the company, or the amount of Bitcoin they have per share, to increase at a certain amount. And that amount is very high for companies like MicroStrategy and Metaplanet, where you're talking about a 400 to 600% Bitcoin yield, where they're 8xing their Bitcoin stack each year per share. And so once you start to see that, you say, wow, this is extremely valuable. And this should be in your portfolio in some amount. Going back to the challenge with convincing no coiners to buy Bitcoin, is that they say, hey, it's too volatile, I'm not going to touch it at all, versus, hey, maybe I should put 5% in, thinking in terms of just percent allocations versus going all in or not all in.
Yeah, I see. And so I think the other question is sort of, how sustainable is this kind of thing? That is it a phenomenon only now in the fiat world? Like, the way I'm seeing it is, we've got this window from now until hyper Bitcoinization, and none of us knows. It could be 20 years, could be 30 years. And the way I'm seeing it is there's this fiat window, this regulatory arbitrage, if you will, that's what these treasury companies are effectively leveraging. They're using that fiat arbitrage that exists today, and it may not exist in 30 years' time, but, make hay while the sun shines, right?
Right. So the goal is to acquire more Bitcoin, right, as an individual. And these systems are allowing you to do that. One of the things I like about these Bitcoin treasury companies is this is not a short-term play. This system, these dynamics are going to be at play until the debt market is gone, which is a 350 trillion debt market. So that's the exciting thing, is that these are just engineered systems to bring that debt, that fiat, into Bitcoin and be a one-way function where they're only acquiring Bitcoin and never selling it. And they're developing all these tools in each geographic economy to be able to do that. Michael Saylor in the United States with Strategy, and then Metaplanet in Japan are two examples.
Right. And now the other obvious question that people will have is, wait a second, are these, let's say if Michael Saylor or Dylan Leclerc and other treasury companies are out here issuing debt, are the buyers of that debt, are they just suckers? Like, why don't they just buy Bitcoin themselves?
Yes, they are suckers. There's an opportunity cost where they should be buying Bitcoin, but they can't. So a lot of these systems and government structures are designed, bond funds, insurance funds, they have mandates to buy debt. And Michael Saylor and these Bitcoin treasury companies are going to say, okay, you need to buy debt. I'm going to give you a percent of the upside of Bitcoin. I'm just going to give you, let's say, a 10% yield. Let's say Bitcoin's doing 60% a year. I'm just going to give you 10%. I'm going to keep the 50%, and I'm going to take your trillions of dollars and put it into Bitcoin over the next couple decades or a decade or so. And so he's going to keep doing that. And the bond market is happy with that 10% yield or interest rate that they're getting. But they can't convince their boards and whole organizations to stop buying bonds and to only buy Bitcoin. Now, if you're an individual, it would make much more sense instead of to buy a bond for, a U.S. Treasury or a Japanese bond to invest in, Bitcoin. But a lot of these larger organizations can't do that. There's just too much of a hurdle.
I see. And it could even make sense, even for a Bitcoiner, if they were to think about like, okay, maybe most of their stack is in Bitcoin, but maybe they are, let's say, more advanced in age towards the end of their life, and maybe they want like a small portion of this kind of Bitcoin, associated debt or some kind of preferred stock that is being issued by some of these companies. So, it's not even a totally binary question, although, of course, not your keys, not your coins. The most safe thing is Bitcoin that you are self-custodying. And it's important for people to understand there is an additional layer of risk versus simply holding Bitcoin, but it's not a binary 0 or 1. It's not like you have to be all in on treasury companies or 0. You can take a small percent.
Right. Exactly. And so one of the things that these companies are doing is offering products for people to invest in. So I've had people reach out to me that I've been trying to orange pill for a long time. They finally said, hey, what about this strike product or the fixed income product that MicroStrategy is offering? Can I invest in that? And I go, yes, that's a great product to invest in. So what they're doing is just providing financial products that are based off of the Bitcoin returns that people would want to consume and invest in. So whether that's insurance companies or individual investors that just want that money in their retirement account and generate that yield and don't really want to do the work to understand Bitcoin. It's a very simple model for them. Hey, I want a high yield compared to what they have in the market, the 10%, but they don't understand Bitcoin. They're not sold on the 60% returns. They haven't done the homework.
This episode is brought to you by CoinKite, the makers of my favorite Bitcoin hardware wallet, the Cold Card Q. Now, some people think self-custody is too hard, but it's really about taking responsibility for your Bitcoin wealth and understanding that self-custody gives you a true feeling of liberty. The Cold Card Q has a full keyboard and big screen. It's got 2 secure elements and a true air gap, allowing you to go fully air-gapped using QR codes from seed generation to transaction signing. You can power the device using 3 AAA batteries, so you don't even have to plug it into the wall for power. You can easily use it with Sparrow Wallet for PC or Nunchuck on mobile, and you can dial it into the right level of security and complexity that you choose. If you want a simple setup, just use 12 words and single signature. If you want passphrases, easy. If you want to add multi-sig or co-signing features, you've got those too. So go to coinkite.com, use code Livera to get 10% off on your cold card or other devices and level up your self-custody today. This episode is brought to you by Galoy, builders of banking software for the Bitcoin age. After years of risk and uncertainty, Bitcoin and banking are colliding. The regulatory environment is rapidly shifting in favor of Bitcoin and digital assets. Fintechs and crypto-native companies can become chartered banks, and traditional banks and credit unions will launch Bitcoin products. But the legacy core banking software that many financial institutions run on wasn't built for Bitcoin. The Galoy banking infrastructure stack delivers all the key elements of a modern core banking platform with cloud-native infrastructure, event-based architecture, and robust APIs coming together to meet the security, scalability, and reliability needs of banks of the future. Whether you are launching a modern financial institution from the ground up, or you are adding Bitcoin-backed lending or payments to your product offering, talk to the team at Galoy. Visit galoy.io or reach out to the team at biz@galoy.io. Yeah. And now, when it comes to accumulating more Bitcoin, some of these Bitcoin treasury companies, they're in different countries around the world. Maybe they're accumulating at a different pace, and of course, they're starting from different positions, right? Obviously, Michael Saylor is he's got the 600-pound gorilla in the room with MicroStrategy or strategy now. Maybe some of these other treasury companies, they're coming off a smaller base, so maybe they can have a higher pace of accumulation or a higher BTC yield. How do you seeing that dynamic there of the different size of these different companies, as well as the different jurisdictions that they operate in.
Right. So the formula to me is kind of what capital pools are they accessing. So you've got the Japanese economy, you got the US economy, companies are popping up in Brazil, Europe, obviously, and a lot of other, China are starting up, Singapore, starting to pop up in those areas. And so what each company is like an engineered tool to be able to start to plug into those capital pools. So you have to understand where they are in their structure, like how many tools they have. Do they have a fixed income product, convertible debt? Can they ATM? There's governance around each geographical location, right? So there's different rules and regulations for each geographical location, which you have to understand. And then that team's ability to build those products quickly or already have them. So that comes into like a velocity of the debt or the money to come into the system, and the company's ability and management team's ability to build products to continue to bring in that capital. So going back to my friend I've been trying to orange pill for a long time, and now he reaches out to me on his own and says, hey, I'm thinking about buying the financial product from Strategy to get a 10% yield. So MicroStrategy's ability to offer that product allows them to bring that capital in quicker. And some companies don't have those different products. So it just depends on the demand of the geographical area for yield, then the company's ability to create products to capture that demand.
Yeah, I see. And I think the other term I've heard used is captive pools, which you were touching on earlier, that there are some institutional investors where they have a mandate or they have various compliance things that they, even if they wanted to just buy Bitcoin and put it in their cold card, they couldn't. So
Right.
They are forced into looking at some of these other things. And so there's a regulatory or a compliance advantage to some of these things, whether it's the direct buying the equity of these Bitcoin treasury companies or buying, as in the common stock versus, let's say, preferred stock or some kind of debt offering or a convertible note, or, different situations in different countries. But that's part of why there is this, let's say, sustainable reason for it to exist, that these people aren't able to just buy Bitcoin themselves, right? And I think that's probably the big mental hurdle, let's say, because if you're kind of in the online Bitcoin world, the answer is, oh, just buy Bitcoin and put it in your multisig, right? But no, there's this whole world out there of people who can't just do that or won't just do that. And that could be for regulatory reasons or maybe even psychological reasons.
And I think there's also consensus, right? I think we forget that we're early Bitcoiners, we're the 1% in terms of this regard. But if anyone has a board and an organization, by definition, if we're early and we're the 1%, in any of those organizations, 99% of people disagree with you and aren't Bitcoiners and aren't going to change their whole management and archetype to be able to buy Bitcoin because they're not Bitcoiners. So these Bitcoin treasury companies were usually smaller CEO-led organizations that made that switch and now are on that path. So I think it's healthy to think about that as well, because using that logic is like, well, why isn't everyone doing it? It's just because they haven't thought about it and there's not that consensus within the organization. We're still sub 1% adoption of Bitcoin, and we have to keep that in mind. And Michael Saylor and these Bitcoin treasury companies are creating financial products to be able to fit the needs of that 99% and those $300 trillion of debt and fiat currencies to bring it into Bitcoin versus waiting for that consensus and flipping to consensus pretty much, where we're waiting for everyone to kind of agree with us before the money starts to come in.
Right. And as Michael and others have said, that there was a journey to go on there, that there are times where they had to change the board or change the structure of the company to enable this kind of strategy of, number one, just buying Bitcoin and putting it on the balance sheet, and then number two, actually using, let's say, financial engineering or some form of equity and debt offerings to accelerate the pace of Bitcoin accumulation further than merely buying out of cash flow, right? Like, it's not just buying out of cash flow, it's using these debt and equity instruments to actually, do it better. So I guess this does come now to, there are different forms and ways of doing this. And so I guess here we're getting more to the question of like debt structuring and this so-called talk. So is this something I presume this is something you've been looking into? Maybe you can give listeners a bit of an overview there. What is talk and how do we think about that?
Yeah, so going back, hopefully you can follow my analogy, but of this dam and the pressure of these capital pools to get into yield, and the company's ability to create financial systems or turbines to bring that in. And each turbine or each system, the ATM or being able to issue shares, fixed income, and the convertible debt all have different um, ability to generate Bitcoin yield in the short term and the long term. So there's a kind of a growth there. And so one thing on one end that's the lowest return is just being able to issue shares and buy Bitcoin, um, issue common stock and be able to buy Bitcoin because they're diluting the shares of the company. So you own those shares. They're diluting it, but they're not doing it in a creative way. In other words, they're diluting it as the whole pie to be able to give to the market and be able to buy Bitcoin, but you as a shareholder are still increasing your Bitcoin. You're just not doing it as much as you could if they were to issue a fixed income product. And the nice thing about the fixed income product, and the fixed income product is just a debt instrument where they issue that debt, let's say $1 billion, and they give the debt market that 10%. Why that's so accretive in what we call torque, because they're not issuing any more common shares of the company, and therefore the Bitcoin yield, all that Bitcoin yield goes directly to the shareholder and not to diluting shares. And so each one of these instruments has a different impact. All are positive, but some are more positive than others. And why that matters in terms of the debt product is because the debt products can scale up to a $350 trillion market. So once that ball gets going, that turbine gets going, they can start to bring in trillions and trillions of dollars to the Bitcoin ecosystem, and it's accretive to the shareholders, and there's absolutely no dilution in terms of issuing more shares. So it's just extremely accretive to the companies.
Yeah, and so and the talk concept is another interesting one because again, it's like a whole new rabbit hole to sort of go down. So for people who maybe they're used to thinking of like public keys, private keys, and all this other stuff in the cryptography and all these other elements of Bitcoin, this is now another thing to learn. So the talk, I guess the simple way I'm trying to understand this is if you issue common stock equity, that's the lowest end of talk. It's still good. It's still accretive as long as it's done, correctly. It can be accretive to the common shareholders, but it's the lowest talk. Whereas higher forms of talk are where there is less dilution. And so there's different trade-offs and different instruments, but the idea is the higher talk options are less dilutive to the common shareholders. And so that can be really interesting because then just by being a treasury company common stock shareholder, you can sort of benefit from those operations that the company is doing because it's kind of, you can sort of think of it like the company is getting a better deal or in getting you BTC yield.
Right. And you have to compare these different companies because they're generating extremely high Bitcoin yield, doubling or tripling their Bitcoin stack every year. And that, as a Bitcoiner, should be very appealing, right? And then you should ask yourself what the risk is, because imagine if you're able to triple your stack, a lot of people feel, as almost everybody does, that they came late to the game and they wish if they would have got in a year earlier, they would have had X amount of more or whatnot. But the Bitcoin, this is still early. That's why it's an asymmetric opportunity on top of an asymmetric opportunity, where you literally have the ability to put in 10 Bitcoin and have it go to 40, right? And so you have to ask yourself, what the value of that is and if that's worth exploring and doing the due diligence to understand.
Gotcha. Yeah, and just one more point on the talk. So we spoke about let's say the bottom level of that. Not as bad, but just it's the most dilutive ATM equity, as in issuing common shares, and the higher level of that, which is this kind of fixed income note. And then there are some in the middle. So maybe you could explain a little bit on that, like the Fiat convertibles as an example, just so people can think through what exactly is happening there.
Yeah, so the fiat convertible debt that you're referencing is what traders use a Black-Scholes model to trade the volatility of a stock. So they don't care about the stock. They're not a long-term investor in the company. They don't understand Bitcoin. They just like that it's volatile. And so there's an equation that they can use to to capture that volatility. And that's what the convertible debt bondholders are doing. It's a smaller market compared to the 300 trillion that I was mentioning before, but it's a market that wants that volatility, that's accessing these Bitcoin treasury companies for that volatility that they can trade on the stock market. And so that's one of the tools that they use. And that's more creative in terms of that torque. It's kind of in the middle of the road in terms of torque. The fixed income product is most accretive. You can use this convertible debt, and then you also have that equity ATM issuance that's kind of on the lower end, but it's still adding a lot of value to the organization. And then there's a lot more products coming out right now. So the blockchain group who Adam Back's part of, they're also doing Bitcoin convertible denominated convertible instruments, so that you give them Bitcoin, and then if the price appreciates of the stock by 30-40%, then you can capture the stock on that. And if it doesn't increase, then they give you your Bitcoin back. So what's happening is that there's all these financial instruments that are coming on the market that allow you to assess the risk, invest in it, and kind of continue to that fiat money continues to come into Bitcoin, or leverage it in a different way. So that's a general overview. And I just like to think about each one of these tools is how that company can suck in that demand and generate that Bitcoin yield.
I see. Yeah. And so now I think the other point here, as we're talking about these different instruments, again, different countries have different options and things available to them. And so do you want to just outline a little bit there? Like you were touching on Japan, because they have like quite a low interest rate or low bond yields. And so that's, I guess, one example. What about other parts of the world?
Right. Yeah. Great question. So one of the things that's interesting is trying to get an understanding of that demand. Japan has, I think, $14 trillion in assets. They've got negative yielding debt instruments when you adjust for inflation. The government says, I believe the inflation is around 3%, and their debt is yielding sub 1%. So they know that their ice cube is melting, versus countries like the United States, where we have like closer to a 5% treasury yield. And then our stock market has been going up and to the right for the last 50, 60, 70 years. So why that's important is that everybody in the United States feels like they're getting a really good return, but everyone in Japan knows they're not getting a good return. You can compare that to other capital pools like in Brazil, where I think their treasuries are upward, or their debt is upward of like 10, 11%. And the same thing with their stock market. It's been up and to the right, getting an 8, 10% return, not adjusted for inflation, but the people that are in those businesses that are allocating capital feel like they're getting a good return. So you have to look at each capital pool and understand what's going on, how close they are to high inflation or hyperinflation, and how those individuals would feel about capturing some type of yield.
I see. Now, I'm curious your thoughts on when there are multiple Bitcoin treasury companies in one jurisdiction. Mm-hmm. How do you compare those? Is it based on the leader? Is it based on their pace of acquisition? Is it their execution ability? Is it any special competitive advantages that they may hold? How do you compare them when they're in the same jurisdiction, especially?
Well, I think they're all comparable in a lot of different ways, where it's just the velocity of bringing that debt or that equity, that dollar amount, that fiat amount into Bitcoin is their competitive advantage. So if you're a smaller company and you can bring in, a quick $1 billion, but you're going to cap out at $1 billion, then that's all you've got. But some of these other companies, MetaPlanet, MicroStrategy, might have the ability to tap into a $350 trillion market. That might be what they're going after. So you have to look at what capital pools are going after, how deep are those capital pools, and the velocity of that money being able to come in, and that company's ability to execute on that. So those are the factors. They can be in the same area, and they can both be splitting that, but they're both bringing in so much money in those capital pools that they're generating a high yield. And it's not they're not exclusive in terms of like they're competing each other. They're just both trying to do a land grab of how much Bitcoin they can get using that fiat debt to do that. And the demand for the fiat debt to get out of their capital pool kind of is one of the major things that a lot of the Bitcoin treasury companies leverage to be able to generate that Bitcoin yield or increasing their Bitcoin stack.
And it's also worthwhile pointing out here that yes, they're quote unquote in competition, but they're also in a sense co-opetition, right? Because everybody's buying the same thing. And so when one company in USA is buying it, that also raises the price of Bitcoin on all things equal. It raises the price of Bitcoin for everybody. And so it is a little bit of a rising tide lifts all boats situation here. But of course, people will naturally compare these different companies and they may be allocating differently to them because maybe they see it like, oh, this company here, they're executing really well. Maybe this other company, they're not executing so well, or maybe it's kind of unclear about their strategy. Maybe a good example here might be the GameStop thing because people were sort of maybe a little disappointed with with the way the GameStop management were speaking about things in terms of Bitcoin and with their strategy, whereas other companies have really been very consistently executing. I'm curious if you have any comment on that.
That's a great example. One company kind of took one debt instrument and they just did it one time, and they don't have a high velocity of new incoming debt or incoming cash flow to continue to buy Bitcoin. And so they're not going to be able to generate a yield. And so that's where this Bitcoin treasury comparison starts to get interesting. How committed is the management team to taking that debt or that fiat currency in the equity market and using the different tools they have available to bring that in? And what is your belief, if you do the math on that, how much can they bring in and how big the company is? GameStop's a bigger company, so they need to bring in a lot more capital at a lot higher velocity than, say, $1 million company or a company that's only valued at 500,000 that's getting kind of that quick scale up, and they can start to touch those capital pools that are in high demand maybe very quickly. And so that's all a function of the size of the company, how much money they're bringing in, how quick, and then of course the management team's commitment to do that. And of course, GameStop isn't committed to using that debt market to generate a Bitcoin yield, while Metaplanet, MicroStrategy clearly are. They've articulated that in their vision, and they've been executing on that. Where I believe MicroStrategies has a 90% trailing 12-month Bitcoin yield, and MicroStrategy has close to 1,000% Bitcoin yield, which is obviously very high numbers.
You mean Metaplanet, yeah?
Sorry, yeah, Metaplanet, excuse me. Sorry.
Yeah, gotcha. Yeah.
But
again, it's relatively a new thing, right? Because Metaplanet, I think, only started their strategy like a year and 2 or 3 months ago, something like this. Like maybe I can't remember the exact date, but we're talking like March or April of 2024, something like that for Metaplanet. Now, and yes, they've come off a small base, but they've been really accelerating. And as you said, they are in a very favorable jurisdiction, Japan. And so maybe that's a factor in their favor. And so I guess coming back to this kind of mNAV greater than one conversation, which, I guess that comes down to how do you justify it, and as to the point of what you were saying and what we're talking about here, it's like if they're really good at executing, if they're in a jurisdiction that is favorable for this, they can sustain this mNAV greater than one, for good reason, because again, they are achieving BTC yield, right? That's the bottom line, isn't it?
Yeah, exactly. If you do the math, and I've written an article and it's pinned to my Twitter thread or Twitter account, and it graphs the Bitcoin yield for Metaplanet, rough numbers, and then the mNAV around it. So if the company, going back to the kind of housing analogy or developer analogy that we used before, if the organization is doubling the amount of houses they have every 60 days or every year, and you're waiting for the stock price to dip by 5% or 10% to have that mNAV drop, or multiple to net asset value, you're going to be waiting a long time, because in 60 days, let's say the mNAV is 1, they've doubled their asset value in 60 days. Therefore, their stock is double what it was before, and you're still waiting for the mNAV to drop by 5 or 10%, and you think that's an entry point, as opposed to graphing out their Bitcoin asset accumulation over 3 years and seeing that they're doubling every 60 days. Therefore, if you're waiting 60 days, you've missed out on the gains if the mNAV is 1 consistent in this whole algorithm. So it shows you that it needs to be greater than 1. We can now of course, dialogue about why it needs to be greater than one. In addition, these companies have tools to buy back their own shares, to do other kind of hedging strategies. So it always would stay in that one range. They can kind of, again, buy back
They
their
can
own shares,
manipulate it a
keep it at
bit, yeah.
one.
I
And
just thought of a
so
good Bitcoin analogy. I thought this would be good, just to explain and get your reaction as well. It's like the equivalent of, when you're trying to talk to a no coiner and they're saying, like, like Doomberg, oh, I'll buy some when it goes under 5,000. It's like, well, if you're waiting for that, you're going to miss out on, all this upside because you didn't understand correctly what was the phenomenon at play here. And so it can seem so crazy or, too good to be true. But it's like, the way I'm thinking about it is, there's the world right now. It's, if you think about this Croesus BTC, the Jesse Myers kind of chart of like 1,000 trillion financial assets, and Bitcoin is only 2 trillion. Like, we're just so early. That's just why there's this massive opportunity right now. Of course, there are risks. It's not risk free, but there's a huge opportunity for this market to grow. And I think it's important that we, as Bitcoiners, try to understand what's happening. Whether you participated in it or not, we have to try to understand it.
right, and it is the same kind of framework where people are hoping that the price of Bitcoin is gonna drop back down to 5,000 because they heard about it at 3,000. They missed the opportunity at 5,000, and now they're kind of like, well, I hope it's gonna drop back down. It's 110,000. They're not asking the question is what is the value of this company, or sorry, of Bitcoin in 5 to 10 years on this current run rate. And the real risk is missing out on all that upside gain. And they haven't thought about it from that framework. They just want to get it at a lower rate than what they heard about it when they first heard about it. So they're waiting for it to drop back down, which is an unhealthy perspective. What they really need to think about is like, this is continuing to go up by 60, 70, 80% a year. What happens if I don't get in now and it goes to 1 million, 10 million, 20 million? And because we're on the sub 1% adoption curve, and it usually there's an inflection point around 8 to 10%, arguably adoption is going to go up and not down. So these numbers are going to increase and not decrease once we get to that adoption and inflection curve. So
yeah, interesting.
What I'm saying is that the real risk is not being in this, because you're going to miss out on it. And both that logic applies to both the Bitcoin treasury companies and to Bitcoin.
Yeah, and to Bitcoin itself, right? I see. And so I think the other point that's probably good to clarify for people and to hear your explanation on this is the interaction of mNAV and BTC yield, right? Because the common, like, if you're not thinking about this, you might just sort of think, oh, I need to buy it at this particular mNAV and then sell it at 2x mNAV. Like, but that's not quite right, because in this case, what we're talking about here is, did that company achieve BTC yield in the time that you were holding it? That's bottom line, isn't it?
Right. That's the major factor, is what yield they're generating. And because these companies are generating such a high Bitcoin yield, or they're multiplying their stack so quickly, going back to Metaplanet, about every 60 days, they're doubling their Bitcoin stack. You're going to be waiting a long time for it to get under that mNAV. First of all, markets are forward looking, so that mNAV is never going to go negative. And so if you're waiting for that you're playing off that mNAV amount, or instead of doing the math on a 300% increase or 500% increase for these Bitcoin treasury companies, that the value of their stock should be increasing by 500% a year if the mNAV stays at 1. In addition, you can have the mNAV also continue to play off that and increase that. And so that is, again, going back to the Bitcoin example, that's the unhealthy way to think about it. They're not thinking about the rate of growth and factoring that in, and kind of, I don't want to say they're risk models, but they're purchase entry prices for the asset. And so this is the ultimate time in the market versus timing the market asset. You do not want to try to time this, maybe in a week or two, but you want to plan to get in a short time frame and not wait for some kind of long process.
I see. And I guess those big numbers you were giving before, I would say that, to be fair though, that relates more to the smaller ones, right? Not to MicroStrategy, because obviously MicroStrategy is not going to be hitting like 300% BTC yield, but maybe a Metaplanet or some of the smaller ones. I say small, they're still big, but relative to MicroStrategy, they're smaller, right? So therefore, the yield possibility is greater, but maybe the risk is also higher too.
Well, and we should dive into the risks as well, and kind of go through that. But I think it's hard to say the size, again, the velocity and the size of the company matter. The velocity of the income coming in or the debt coming in, their ability to use the tools that they have to put that into Bitcoin to generate the yield matters. So right now, I'd argue that MicroStrategy kind of hit a little bit of a lull. They're trying to generate these fixed income products to, again, address the $350 trillion fixed income market, that debt market. But let's say that they offered them half the returns of Bitcoin, let's just say that's 30%, they could start to generate extremely high demand for the fixed income product tomorrow. So why that's important is because let's say that they did that and the $350 trillion of that's starving for yield goes, hey, that's 10 times higher than I'm currently getting. I'll give it to you all now, and that's the end of the game. So like that's an extreme, obvious example, but it's an example that is possible. But it of course comes back to like shows the importance of the velocity of that money coming in and how they structure these products. So MicroStrategy could still have a higher yield than some of these other companies. It just depends on how quickly they can bring in that fixed income debt from one of the largest markets in the world. And of course, the size of the company matters. If you're a smaller company, a $1 million company, and you can offer fixed income products to those $350 trillion, like that's the perfect scenario, right? But
right, yeah. But I guess the argument would be MicroStrategy or strategies ones are more easily able to get a credit rating, and because of their size, they're more investable for some of these larger pools of capital. So maybe, yeah, the argument would be, look, MSTR and their associated instruments are kind of playing at a different level, and so they can access these bigger pools of capital, but also they are so much bigger. So it's just a lot harder to move, to sort of dramatically get this kind of crazy, meta planet level numbers because they're already so big. Right. Is how I'm thinking about it. But let's go to the risk question as well, because we don't want to just be totally, rah, it's there's no risks. It's totally risk free, just like Raoul Pal or whatever. His infamous comments about Terra Luna or whatever. Let's talk about the risks. What can go wrong here with these treasury companies?
Right. That's a great question. So I think the first thing is we have to assess is like the governance and how good companies they are. This isn't an FTX. These are publicly traded companies on their respective stock exchanges. They've got governance models. They've got auditors. So you really have to kind of at least not associate the FTX and the GBTCs with these companies and kind of pull back layer, which I guess is what we're doing now, is to understand those particular risks. So each one of these companies has different risks because they're in different jurisdictions, right? There's obviously government risk. If the governments try to take over the companies, there's a risk there. So they do add an additional layer of risk. But thinking about how the system can kind of break down, so to speak, for both Metaplanet and MicroStrategy, going back to the real estate analogy, MicroStrategy has about 20% debt of their assets, and then MicroStrategy has about 10% debt of their Bitcoin assets. So going back to the developer, this developer only has 10% debt, is increasing his base of houses by 5 to 10x each year. And then in the worst case scenario, if we have a huge drawdown, he might have to sell a few of his houses to pay off that 10% of his debt, or maybe 10% of his stack to pay off that debt. And that's in a worst case scenario. And going back to the MicroStrategy, they have debt instruments or contracts that are five years long. So a full cycle, which is a pretty good amount of time. So even if the Bitcoin price were to drop to, let's say, 5,000, MicroStrategy can weather that storm for a very long time before even having to sell the Bitcoin. And that sounds kind of risky. No one wants to sell their Bitcoin. But you have to keep in mind that these companies are acquiring so much Bitcoin that even if they have to sell 10% of their stack in 2 years, you're still going to be up by some form or function of Bitcoin, your Bitcoin stack. So Metaplanet's doubling their Bitcoin every 60 days. If they have to sell 10% of their stack in 2 years, you're still up dramatically in that scenario. And the engine just stopped or stalled in terms of this flywheel. It didn't explode, if that makes sense.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold Vault is a 2 of 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Cold Card hardware wallets to spin up a Bold Vault in just a few minutes, and the Bold Vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. And now, back to the show. Okay, yeah. So the risk might be that let's say it's a bear market and they are not able to accumulate at the same pace in that bear market. Right. And I guess that's maybe one thing where out of all these treasury companies, it's only Strategy who was around who was doing this in the last bear cycle. I believe they only ever had to sell one time, and that was like a tax loss harvesting thing where they kind of sold and rebought and something like this. But other than that, they've not sold. So I think that's perhaps been an interesting indicator for people. Of course, there is that debate also about if these companies have their mNAV go below 1, would it actually be to their benefit to sell some Bitcoin and buy shares to increase the BPS? So the argument there might be, there's a contradiction between this idea of never sell your Bitcoin and on the other hand, this idea of always increase BPS. Maybe in a bear market with mNAV lower than 1, there's a potential. But again, it comes back to what are the ways the different companies are going to manage that. Are some of them going to try to do like fiat debt to buy back company shares to raise BPS that way? Like there's just different ways that those scenarios could play out. But I guess the big one most people will be thinking about is the typical, FTX style sort of cascading liquidations, right? That if, for some reason, maybe not the well-known, the big ones, but maybe lesser ones or maybe ones that have not been managed so well, or ones that were too aggressively levered, maybe they're the ones at risk. What do you think?
We'd have to get specific, right? I think that's the thinking that a lot of people have when they're entering Bitcoin. They're like, well, what if this happens? What if this happens? Like, well, let's play out that scenario. There's no companies that I'm really aware of that are taking on too much leverage going back to the yield versus their leverage. If they're doubling their Bitcoin stack every 60 days or doubling it every year and they only have 10, 20% leverage, that's not too risky for me and for my blood, especially just understanding the simple dynamics of just taking debt that's inflating away and putting it in an asset that's growing and is scarce. And that's a very simple, very basic business model that I can get on board with. And so we'd have to address each individual new Bitcoin treasury company, but you'd hope and you could argue that these Bitcoin treasury companies would get smarter with each generation. But you could also argue that they get a little bit more risky because they're trying to outcompete each other for attention and desire and whatnot. So the companies that I'm talking about, MetaPlanet and MicroStrategy, just have that 10%. And so we'd have to get into specifics. If there's a company that's doing 200% and they're mark to market, and they don't have as much collateral, they're not collateralized, then yeah, you can argue, and then you'd have to just do the math on all those dynamics and what type of yield they're generating compared to the opportunity cost of some of these other Bitcoin treasury companies and what the risk is. Yeah. But right now, using those two as an example, it doesn't seem very risky. It seems extremely high reward. And we know where the yield's coming from. So compared to where FTX and some of these crypto token systems that were supposedly generating yield, it was really just a Ponzi scheme. This, on the other hand, we know exactly where the yield is coming from. We're taking out fiat debt that's inflating away, and we're putting it into Bitcoin that's appreciating. And if that's a very simple thing, I think most Bitcoiners can get their heads around. And Jesse Myers, Pierre Richard, articulated in some of their articles around how to use fiat debt to put into Bitcoin and the kind of math behind that.
Yeah, I see. And is there anything on like a dilution risk? Like, is there a way that, the common shareholders are just going to get diluted in a way that's not accretive? Or does that just come down to professional management and just making sure that you are doing it in a way that's accretive?
Yeah, I think it does come down to professional management. The nice thing about this model, it's a simple model. If it's not accretive, you can do the math. It's almost basic algebra. And if it's not accretive to your shareholders, you don't do it. It's something that if you put me in charge of MicroStrategy, I can do the calculation, say, hey, if this debt's not coming on and accretive to our shareholders in some capacity, then we're not going to do it. Now, there's obviously the opportunity cost. You want the best management team to be doing the most accretive things. But at the end of the day, it's not a complicated process. We're only going to increase Bitcoin per share for our shareholders over time. And if it's not accretive to that, we're not going to do it. Everyone of these management teams understands the game, especially Michael Saylor. Acquire more Bitcoin. The only thing better than Bitcoin is more Bitcoin. And so that's on what he's going to do. And he knows there's a gold rush for the next 10 years to take this debt, fiat debt, the 350 trillion, and put it into Bitcoin through his company.
I see. And what about interest coverage? So when, as an example, the preferred shares of MSTR, so I think they've got, was it Strife and Strike? I'm not sure if Stride is, yeah, anyway, they've got those different products. I'm not totally up on exact specifics of those, but they pay out, I think it's 8% or 10%, right? And so what about that? What are your thoughts there? Would that, could that come back to be difficult for MSTR during a bear cycle or something like this?
I think it's going back to that example of like, okay, let's say if we had to sell 10% of our Bitcoin to pay off this debt, that's not ideal. And you would not be happy with Michael Saylor or Metaplan, especially as a Bitcoiner. You'd be like, how'd you mess this up? Took a little bit too much risk. But again, it's not the worst case scenario because you're doubling, tripling your Bitcoin stack depending on.
So you would still be up, but just not as much is what you
right, exactly.
is what you're saying.
And that doesn't sound like a risk to me. It sounds like a plan. And in other words, like, hey, if you're doubling your Bitcoin stack and then you have to plan to sell 10% of it, let's say in 2 years for whatever reason, even if that was part of the plan, I personally would be okay with that because my Bitcoin has increased per share over that time. And so as long as my Bitcoin is growing, my stack is growing, I'm excited about that, right? And so even saying the worst case scenario is a planned scenario, I personally am okay with that because I'm still increasing my Bitcoin per share or the amount of Bitcoin that I own.
Yeah, okay. So I guess assessing this and trying to zoom out and trying to be objective about it, what are the biggest risks here? Is it just like state capture, state seizure risk, like that the government just seizes the coins? Like, what do you see as the biggest risks here?
Ooh, that's tough. The state capture one seems to resonate with me where this could be a honeypot for different geographical locations, right? So some of these companies are starting up in China or Hong Kong. I'm sure there's going to be ones popping up in Russia, right? That could be a risk, and you have to assess that risk and that probability, especially compared to the yield that you're going to be getting for the Bitcoin Treasury companies. So you have to assess that risk, but that would probably be the number one risk because, I'll leave it there.
Yeah, fair enough. And so let's say from a personal perspective, right? Like from you or me or just everyday individuals, everyday hodlers who want to do this kind of play, how do you think about this idea of taking profit into Bitcoin, right? Like we're Bitcoin maxis, one Bitcoin is one Bitcoin. Would you see this as like you would periodically put some into a treasury company and then try to take some back into your, like sell some, turn it into Bitcoin, withdraw to your multi-sig, or like how are you thinking about this idea of taking profits?
Yeah, I personally am not thinking about taking profits. There's a stack that I have that's staying in these Bitcoin treasury companies and will stay in there until fiat's gone. So until hyper-Bitcoinization is here, and then I might take that out. But even then, I think there's a lot of things you can do. These companies can do. Become an insurance company. Become an insurance company is a great example. So I don't plan on taking any of that money out for that opportunity cost. Besides maybe some living expenses and buying a Ferrari or something like that. I'm just kidding. But that's how I think about it. I think this scales to until fiat's gone, at least the fiat debt market is gone. So I plan to be in these businesses for a very long time. And then in terms of these models and the opportunity, how you think about the opportunity of allocation, there's something called the Kelly criterion. Are you familiar with that?
Yeah.
Yes.
It's known as it's a way of there's two forms. As I understand, there's one that's about gamblers avoiding ruin, and there's another form that's used for investments. But the idea is like, how much of your portfolio should you kind of place yeah, kind of like where should you place? How much of a percent should you place bets? Kind of thing. Like should it be 5%, 10%, or whatever? Right.
And you input into these models the risk of failure or losing the money or of the drawdown, as well as the upside potential, as well as how many opportunities you're going to get. And the opportunities is an interesting one because I don't think there's going to be ever a better asymmetric upside than these two opportunities. So you have to Bitcoin and then Bitcoin Treasury companies. So when you do the math in your own assessment of the risk, let's say of a Bitcoin Treasury company, and then the upside of a Bitcoin Treasury company, then you can do the portfolio allocation that makes the most sense based off of your needs. So you mentioned a risk of ruin. You definitely want to think about a scenario of risk of ruin. You don't want to put all your eggs in one basket in this sense because there's a potential risk of ruin. Even if it's a very, 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 very small percentage, you don't want to do that because you don't want to end up, ruined. And so the model shows you how you can put different assets and allocate them based off of the probability of them failing and then succeeding and how many bets you're going to get. So the number of bets is an important one because I don't think we're going to get a lot of great bets here. The average investor, the average retail investor is not going to see much better opportunity than these two opportunities. Maybe if you're a venture capitalist and you're getting into the next Uber, the next Google, you might play the cards a little bit differently, but most retail investors, these are going to be the best two opportunities, asymmetric opportunities.
I see. And so I guess the other element of this, none of us are, tax or legal advisors here, but as an example, or financial advisors, but as an example, people may decide their allocation of like, okay, I'm going to keep, maybe most of my stuff is in Bitcoin cold storage, and then like a small percent goes into one of these treasury companies and another percent into another treasury company, and that's how I'm thinking about it. Or and the other thing to layer on as well is tax considerations, right? Because again, if you're depending on the jurisdiction, depending on capital gains taxes, trying to flip around between these can cause more tax inefficiency because of capital gains taxes. So how are you thinking about that capital gains issue?
Well, the capital gains, you have to do the math on yourself for doing each one of these trades in the upside opportunity, which adds another level of drag. But there's a lot of money tied up in tax deferred investment accounts in the United States and around the world. So that seems like an obvious way to get into these companies quickly and effectively because you can always get out. For some reason, if you change your mind, this sounds like a great idea, you put some money in, oh, wait a minute, we're wrong. You do some more analysis, you can pull it out without a tax issue. So yeah, I think I forget your first part of your question,
right.
But that's
I was just talking a bit about like kind of allocation and how you're thinking about it. And I guess the other way to think about it is you might just be stacking and just thinking, okay, well, I've got some fiat income. I've already got some coins that are in my cold storage, and maybe now with some new fiat income, I'm going to allocate some of that into Bitcoin treasury companies because I believe they will outperform Bitcoin on this kind of risk-adjusted basis. And so maybe that's one way you do it. Or as you said, in these retirement accounts and pension accounts and things like this where people can otherwise stuck in underperforming assets, well then, hey, yeah, go for Bitcoin and Bitcoin equities, and that can help you outperform this kind of underperforming indexes and fiat bonds.
Yeah, and I think one of the things that I've always thought about is that the risk, depending on your age, but let's say you're 25 years old and you've got 30 years of working life and you're making $200,000 a year, all that future cash flow denominated for you is in fiat currencies, right? And so there's a huge risk that a lot of that money will be worthless. And it depends on kind of what job you have. If you're in a government job and it's denominated in fiat currencies for the foreseeable future and you don't have the ability to negotiate that, then you have a real fiat currency risk for the next 30 years, right? Especially if you're starting your career. You're making $200,000 a year. That's $2 million every 10 years, and that's inflating away. And let's say that you only had $10,000. Is it risky to put it all into Bitcoin? But I would argue no, even though it's 100% of your portfolio, especially when you compare it to the cash flows that you're going to be receiving over the next 30 years of your life in terms of income. So I think that needs to be factored in both that helps you think about how to invest in Bitcoin, but also Bitcoin treasury companies, especially when you're on the younger end. And when you're on the older end, it kind of inverts a little bit, but you can still apply that model because you're going to be getting Social Security and pensions and things of that nature.
Yeah.
So
And
that's
I think maybe, and also if you're older, it might make more sense just to look at some of these things like Stripe and Stride and some of those as well,
hmm hmm
because maybe that's where you are more risk averse at that point, and you're okay with getting a bit less return, but you want it to be a bit more safe. I guess the other thing is maybe people might feel like, hey, these things are all a bit new, so maybe that's you're sort of waiting for it to kind of go through a cycle or two before you're ready to sort of commit to them. But to your point, it's early now, and the opportunity is also the asymmetric opportunity is now also. So these are things everybody has to think for themselves. Of course, listeners, I'm not dictating anything to you. Listeners, you are big boys and big girls. You have to make your own decisions. But yeah, I think those are some of the key points. Of course, I want to get your comment on this. We're seeing a ton of new, companies coming out and doing these announcements. Of course, we're still early, but what do you make of this? Like, is it, how early are we? What do you make of all these new companies coming out and basically saying, yeah, we're doing this too. We're doing the Bitcoin Treasury company playbook, or we're buying Bitcoin.
Uh, yeah, I mean, I think they're all trying to capitalize on this very simple business model that Michael Saylor is put out there, right? You're taking the fiat debt and you're putting it into Bitcoin. You're taking the loan out, you're putting it into Bitcoin, an asset that's appreciating at 60% a year, and you're leveraging the different regional capital pools to do that. And I think any company would be silly not to do it, right? It'd be silly not to put their cash flows into Bitcoin, and they'd be silly not to take advantage of these different opportunities. And so, yeah, and because the capital pools are so large and so deep, that we're in the first, you know, at bat of this game, so to speak. Like if we haven't touched the 350 trillion, which we haven't, there's still opportunity. And even if there's just a $1 trillion left, say we're 90% through this process, you still got $1 trillion to capitalize to bring into Bitcoin. That's a lot of money. That's a ton of money to bring in. So, you know, these companies are I think Michael Saylor in particular is really understanding that. And that's why he's developing the different products he has. And he's really pushing for the regulators to approve or the credit agencies to kind of approve his different instruments so he can appeal to these institutions and bring that yield in. So I think it makes a ton of sense. And it's just about their ability. I don't think you have to think about it as like a competitive moat in the short term. It's just their ability to acquire more Bitcoin and have that Bitcoin yield on a risk adjusted basis. Obviously, you have to do a little bit of due diligence and make sure they're not doing anything crazy. And then factor in the actual Bitcoin yield. And one of the things I like about Metaplanet is they just increased their guidance for their Bitcoin yield to about 400% for the next 2 years. Their CEO did that, and so that gives me confidence to start to see kind of forward guidance from some of these executives of what they expect to generate in terms of yield. Because as an individual investor, obviously it's a little complicated, and the proof is in the pudding in terms of what they've been able to generate, and most likely be able to continue to generate to be forward looking in terms of the cash flows.
Yeah. And I think the other comment that at least I'm seeing this, how I'm seeing this, I want to get your reaction as well. But the way I'm thinking about it is like, this is like a new top of funnel, because there'll be new people who come in, they buy something on their app, like the stock ticker of one of these treasury companies, and then they might start learning about Bitcoin and sort of coming down the rabbit hole as well. So I think there is an opportunity on that side of this also, that it supports the Bitcoin network effect as opposed to altcoins and things like this. So that's certainly interesting to me. Yeah, but I guess, do you have any reactions on that or any closing thoughts for listeners?
Yeah, two thoughts on that. One, it's interesting to look at the back to the analogy of the dam and these companies being the spigot to break into the dam. And these capital pools, these fixed income capital pools, are going to be very steady. And so I think that'll mute some of the cycle stuff that we had before, because before you couldn't do a discounted cash flow analysis on these Bitcoin treasury companies. They weren't accessing the fixed income market. So the cycles were very raw, where it'd just be a hype cycle because someone heard about it, the network effect starts going, it starts getting in the media. people start dumping money in, and then all of a sudden the halving kind of takes effect, and or the supply equalizes at a new amount, and you kind of have an 80% drawdown. I think it's interesting to think about the game theory about, imagine just a huge capital pool just coming into Bitcoin through these treasury companies now, and how that might change the dynamic. So I think that's an interesting thing to think about a little bit. But then additionally, one of the things that excites me about these Bitcoin treasury companies, kind of going back to our analogy at the beginning, is like, it's cool to be a hodler of last resort and own it in cold storage. But there's something that's really cool for me to be on the forefront of these ideas and thoughts that are going into these fiat systems and bringing capital from them into Bitcoin. It's a proactive process. We're going out there and making that change and creating financial products to be able to do that. And that to me is kind of really cool, and is kind of the ethos of what I'm about, is being able to kind of create that hyper Bitcoinization in a little bit more proactive way versus more of a reactive way as a hodler of last resort. And I think that's something to keep in mind, because, sometimes I make the analogy to myself that, you think about all the generations that had to fight for freedom in the trenches, pick a side, go to war, risk their lives. And Bitcoin is the most freedom technology out there. And we're not asking anyone to risk their lives. We're just asking them to risk their capital, take their bank account, put it into Bitcoin, and have it there. And to me, that's exciting. And it kind of, I feel like I have a sense of obligation to evaluate this, to try to make Bitcoin happen faster, if that makes sense. Where these people tried to make the world a better place through fighting, and Bitcoin is a technology that will help create peace and freedom. And if we can help structure these products, bring these products into market, it brings Bitcoin into the ecosystem or into the world at a quicker pace. And that's something that like morally excites me and kind of gets my my passion going.
Excellent. Yeah, sense. I think it's a whole new phenomenon. I think we have to try to understand it. And I'm bullish on this category personally. But we'll just have to see how things go and how things develop. But I guess that's a good spot to leave it there. We've done a bit of an overview for listeners. So, I guess, the key takeaway really is just to sort of think about like BTC yield and understand what are some of the risks of this, what are some of the benefits of this, and, make your decision based on that. So before we let you go, Blake, for people who want to follow you online, where's the best place?
Yeah, they can follow me on Twitter X. My Twitter handle is Logical Bitcoin, the letter R, so Logical Bitcoin R on that. And I have some articles pinned to my profile that you can read that kind of talk about this a little bit further. And I'm always tweeting about it. So that's the best place to follow me.
Fantastic. Well, Blake, it was great to chat with you. And listeners, make sure you share this episode if you found it interesting, informative, and go and follow Blake. All the links will be in the show notes. Thank you.
Thanks again, Stephan.